Good afternoon and welcome everyone to a new series of Trinity Talks. We hope you've had a good summer. My name is Rinku Badoria. I'm a partner in the London office of the Trinity team and I will be moderating the session today. So today we'll be talking about rate fixing, the latest about LIBOR. The presentation will be delivered by my colleague, Counsel Barry Burland and Associate Elizabeth Hanley. In terms of format, the presentation will last for about 30 minutes and will allow 10 to 15 minutes to answer any questions. On that note, please do feel free to use the Q&A function on your screens to submit questions during the course of the presentation, and we'll endeavour to get through as many as we can in the allotted time. So without further ado, I will now hand you over to my colleague Elizabeth to kick off the presentation.
Thank you, Rinku, and welcome everyone. So we're gathered here today because LIBOR will be discontinued. Although discontinued is not exactly true, no bank is forced to use LIBOR or not to use LIBOR by law, but central banks will no longer be compelling banks to provide the quotes required on panels for determining LIBOR. So by the end of 2021, that means LIBOR will not reflect the reality and central banks will no longer recommend its use. We should also note that there's no need for doom and gloom. Although many market participants have become accustomed to using IBORs, they're actually a relatively new phenomenon, and financial markets were able to function perfectly well before those rates were widely adopted and will continue to function once they're replaced. And before we jump into the replacement of LIBOR, I think it's worth spending a few moments reminding ourselves of exactly what LIBOR is and how and why it's used. So if we could have the next slide, please, Rinku. So an IBOR is an interbank offered rate. It's supposedly the rate at which banks indicate they can borrow from one another on an unsecured short-term basis. Now, LIBOR is the interbank offered rate in the London market. It's based on 5 different currencies, so the US dollar, euro, British pounds, Japanese yen and Swiss franc, and it's quoted for 7 different maturities. The overnight spot market, 1 week, 1 month, 2 months, 3 months, 6 months and 12 months. When we refer to LIBOR in our sort of project finance documents, what we're most often referring to is the US dollar 3-month rate. And that's the supposed average rate at which a bank can borrow from another bank US dollars for 3 months. And the idea here is to reflect the average cost of borrowing using a transparent benchmark. There are similar pole-based IBORs used in other jurisdictions, such as HIBOR in Hong Kong, MIBOR in Mumbai, SIBOR in Singapore and so on. We should also mention here Euribor, which is the interbank offered rate for the European money markets in euro. IBORs are widely used across markets and they're currently used in around 350 trillion of financial instruments. If we can move on, we'll now look at how LIBOR is calculated. So the LIBOR rate is administered by Intercontinental Exchange Benchmark Administration, known as ICE Benchmark Administration or IBA, or commonly also just known as ICE. Each day, ICE asks major global banks how much they would be charged by other banks for the short-term loans. In April 2018, a new waterfall method was introduced, and that was to ensure the banks, where possible, looked at real transaction data when providing the quotes. There's a designated panel of around 11 to 16 global banks for each currency and tenor pair. For example, 16 major banks, including Barclays, Citibank, so on, constitute the panel for US dollar LIBOR. ICE will receive quotes from those banks on the panel. It then takes out the highest and lowest figures and calculates the average from the remaining numbers. This is known as the trimmed average. So once the rates for each maturity in each currency are calculated and finalised, they're announced and published by ICE once a day at around 11:55 AM London time. And what that is known as in our documents is the screen rate. I'll now pass you over to Barry, who will take us through some of the problems with LIBOR.
Good afternoon, everyone. It's very good to be speaking to you. So what are the problems with LIBOR? Why does it need to be discontinued and replaced? Over the past 10 or 15 years, various problems have emerged. There have been various attempts at reforming it, such as the waterfall method introduced about 2 years ago, but generally among central banks and other controllers of the currency, it's been felt that LIBOR is in fact not reformable. Famously, Mervyn King, the former chairman of the US Federal Reserve, said that LIBOR is in fact the rate at which banks do not lend to each other. And that's really the fundamental problem. It's become a bit of a guess rate, or to be fair, a rate based on expert determination rather than actual transactions. Also, over time, it's been increasingly clear that the IBORs are diverging from other money market rates that are available and used commonly, particularly at times of stress, but generally it is felt, or it is the case, that the IBORs are not reflecting the true cost of funds to banks and other lenders. And over the past 10, 20 years, there have been quite significant scandals involving some of the IBORs, including famously LIBOR in London. So if we can move on to a live transmission from a bank trading floor, we can see that in fact there's little going on. It turns out that for US dollar 3-month LIBOR, that's the most common IBOR in the world, there are only about 5 to 7 transactions between banks. That's actual borrowing and lending between banks every day. For other tenors, for other currencies, there may be no transactions at all. So, yeah, the way in which LIBOR is calculated, or any IBOR is calculated, are in fact not reflective of the reality that they're supposed to be stating, which is the rate at which banks lend to each other. If we move on, we can see that over time, since about the early 2000s, there is a large or growing divergence between the LIBOR rate and other common money market rates, such as the overnight spread rate or the Treasury repo rate. In the early 2000s, that difference was approximately nothing. By 2018, it was approximately 55 basis points. It's probably even higher now. And at times of stress in particular, such as the recession in the late noughties, 2008, 9, 10, you can see that there was an enormous divergence between the LIBOR rates and the other money market rates. It turned out, particularly at that time, many of you may remember it, that banks discovered and started complaining, particularly to their lawyers and their borrowers, that LIBOR was not reflecting their cost of funds, and they began to insist on using other rates as the basis or the benchmark rather than LIBOR. Lawyers will remember drafting pages and pages of fallback language into documents. Many lenders will remember, and borrowers too will remember, great arguments about the number of banks that it took to generate this new process for developing rates. If we move on, we can see another live, we can see the rates quoted by banks, and you can see that over time, this was at the time of the recession in the late noughties, banks were probably not quoting anything reflective of the true reality. Some banks were consistently overquoting in order to exclude themselves from the panel, and some banks were probably consistently underquoting. These are rates in London, and when the Bank of England discovered this, not only did they wrap them quite strongly on the knuckles and take quite a lot of money out of their wallets, but they certainly felt that this is indicative of the fact that the LIBORs were no longer doing what they were supposed to be doing and should probably be reformed or replaced. If we move on, we can see that at about the same time, things get even worse. It turned out that some bankers were actively manipulating the LIBOR rates to generate particular results for some of their colleagues. Many banks in London will find quite significant amounts for what is fundamentally fraudulent transactions. If we move on, we'll be moving back to my colleague Lizzie, who will now lead us through some of the timing for replacement.
Thanks, Barry. So as mentioned in the introduction, central banks are not recommending the use of LIBOR after the end of 2021. If we can move on to the next slide, though, we'll look at a little bit closer at what that means for our transactions. So despite the pandemic, the central banks are not changing their end of 2021 date. However, the working groups had come up with some interim target dates to reach the overall end of using of LIBOR. And those interim dates have been extended, but for most of us, that's not that helpful. We'll see how soon those dates are as we go through this slide. So there's no punishment for not meeting those dates, but market participants do need to start to be aware of how they're going to transition into the new risk-free rates. So as of now, all transactions should include some kind of fallback language or alternative interest rates basis to use to be used after the end of September 2020. So that means as of the end of this month, your transaction should at least include some kind of process for replacing LIBOR with a new rate. So if your document only refers to the process for replacing the rate and doesn't have a new reference rate, and then at least 6 months prior to your next LIBOR reset date, so that would be between June 2021 and December 2021 for most loans, you should know exactly how you're going to work out your next interest rate. So that only gives you until around the middle of next year to have decided with your borrower what that replacement rate will be, how it will be calculated, and how that will be documented in your documents. The back office functions, technology and operations, need to be ready to calculate these new risk-free rates by the end of this month. And for USD LIBOR products, the recommendations from the working group are that no new products should refer to the USD LIBOR rate by the end of June 2021. For other products and currencies, that interim date is even sooner. So as you can see, it's not something we can wait until the end of next year to resolve. It's something that needs to be actively looked at now, and all sort of aspects of a transaction need to be ready for the change. So now we'll go out to Barry, who'll explain further what these new risk-free rates are.
Hello again. So we've told you what's being replaced. Now let's tell you what's coming. There have been several candidates considered over the past few years. Generally, they're all what are called risk-free rates. They have a number of common characteristics. Generally, they reflect actual deep and liquid markets. They are generally published daily. So for IBORs, which as many of you know, refer to periods, generally or most commonly 3 months, but also a week, a month, 6 months or a year, these daily rates will need to be aggregated. As a rule, they do not include any elements, any allowance for bank credit risk as interbank rates do. They allow for no liquidity premium because they are just overnight rates. They are not available for term periods. They're only available overnight. And most importantly, and this is the reason why they are risk-free, is they look backwards to actual transactions. They don't look forward over periods that haven't yet happened. Now, there's clearly going to be, and there is, a difference between the risk-free rate and the current LIBORs. That difference is known as the credit adjustment spread. And during a transitional period, it's expected that banks will be allowed to add a spread to the risk-free rate in order to generate a base rate for their documents that's closer to what LIBOR used to be. What exactly that spread will be is still being discussed, but the general recommendation seems to be that we'll take the median rates over a historical period of 5 years. That's the median rates of the differences between interbank offered rates and risk-free rates. And all of that data is now available. These medians can quite quickly and easily be looked up. Of course, one of the basic fundamentals of an interest rate in a document, will there be account taken of the credit risk of the borrower, will remain. Everybody expects that on top of the risk-free rate plus the credit adjustment spread, there will still be a margin. If we could move on, we'll see the rates that have been recommended for two of the major markets, clearly the major market, the dollar market, and then the market that many of us deal with quite frequently, the sterling market. For the dollar market, although there are other candidates, and indeed people will be allowed to use other rates, the most common and the now recommended rate is something called SOFR, the Secured Overnight Financing Rate, a rate published every day by the Federal Reserve in New York. It is based on transactions in the Treasury repo market. That's a market where people borrow from each other on the basis of treasuries, US government bonds, that are given as collateral, and they borrow only on an overnight basis. SOFR is based on actual transactions drawn from all participants in that market. And more recently, the Fed has begun to publish rolling averages over 30, 90, and 180-day periods, and an index of the rise or fall, I suppose, in that rate since the date it was first published in April 2018. That index is not actually terribly perfect for loan products, and so it's probably not something many of us will see in the loan market, but it is very helpful for floating rate and derivative transactions, and so will be used quite frequently. In the sterling markets, we'll be using something called SONIA, or we may be using something called SONIA, the Sterling Overnight Index Average. That, again, is the average of the interest rates that banks pay to borrow sterling overnight from other financial institutions and institutional investors. That too is a rate based on actual transactions. It's quite a deep and quite a liquid market, and it's already quite a common rate. It's used to value about 30 trillion in transactions today. The Bank of England publishes that rate. They've been publishing a compounded rate since August of this year. And really that compounded rate will provide a standardized basis for people who use the rate as their loan basis, to quote. It's worth pointing out, as Lizzie mentioned earlier, that EURIBOR is not being replaced. EURIBOR will still be available after the end of 2021. And so in multi-currency transactions that include both euro and sterling dollars or any of the other rates being replaced, you may have two very different ways of calculating interest. But moving on, let's speak about the way in which risk-free rate-based interest will be calculated in future. There has been a lot of discussion because clearly there are differences between the IBORs, term rates, forward-looking, quoted on screens, and the risk-free rates, which in many ways are different. For the dollar markets, those based on SOFR, recommendations came out first in May of this year. They've been updated 2 or 3 times, most recently last week. For the sterling markets, that is rates based on SONIA, the recommended conventions came out just last week. And they go to relatively technical matters like the methodology in which rates will be calculated, how you calculate them, lag times, how they'll be rounded, day count conventions, all of which we'll now speak about in a little more detail. Moving on then, let's look at some of the fundamentals. Interest will be calculated in arrears, as generally it is now, although unlike now, where borrowers and lenders could work out how much interest they will pay at the end of the interest period at the beginning, in future, on a risk-free rate, you will only know how much interest you are expected to pay or to receive at the end of the period, because the rates on which you will make that calculation are not known until the end of that period. Now, you could take the daily rates, the daily risk-free rates, and work out a simple average for your period, just to add up all the rates over, let's call it a 90-day period, divide by 90, and you have a rate for the period. But as many of us will know, that doesn't really reflect the time value of money. And so the recommended convention is that we will compound rates over the period. So in this case, we'll be compounding for 90 days. We could, of course, compound rates, or we could compound the balance of the interest that's payable on each day. the recommended convention is that we compound the rate. Now, in most cases, we should get to the same figure at the end of the period, but compounding the rate allows calculations to be made inside a period more accurately. Those are calculations for events such as a prepayment of a loan or the transfer of principal plus some amount of interest between lenders in the middle of a period. They also allow for a slightly more accurate prorated distribution of interest between lenders. Moving on. We're now going to speak about whether we accumulate the rate or we don't. A cumulative rate would be a rate calculated for the entire period at the end of the period. And it would allow the generation of an amount of interest, once multiplied by the loan balance, at the end of that period at a single rate. The non-cumulative method would be based on that rate, but it would be that rate every day minus the rate of the previous day, giving you a non-cumulative rate for every day in a period. What you'd be able to do with that is then generate a daily interest amount. You would add that amount up at the end of the period, and that would be the amount payable. But if something happens during the period, the same thing, the prepayment of a loan, the transfer of a loan, the non-cumulative method is going to give you a much more accurate view of how much interest is due when that event happens, rather than at the end of the period. If we were to pay in the normal way, allow for the loan to be outstanding for the entire period and then only pay at the end of the period, the two rates would give you exactly the same figure. And in fact, the two rates give you only very slight differences when you calculate them during the period. But of course, slight differences on large loan balances can add up, which is why the recommended convention is to use the non-cumulative method. Moving on. We'll begin to hear a lot about observation periods. Observation periods are those periods from when you take your risk-free rates to be applied to your interest period. Generally, your observation period and your interest period are going to be of exactly the same length. So let's call it 3 months or 90 days. But they won't be exactly the same period on the calendar. There will be a slight lag between them. During any one of those periods, we all know there will be weekends, there will be public holidays. And the question is, when those happen, are you going to take account of them during the observation period, or are you going to take account of them during the interest period? When things happen normally, it shouldn't make very much difference at all. But it turns out, in various worked examples and over the consultation period, that where there have been sharp changes in the rate downward, if you were taking the rates from the observation period, the calculations were generating negative interest around those periods when there was a sharp shift downwards around weekends and bank holidays. That does not happen when you are weighting your interest period. So the recommended convention is that we go without observation shift. That means we calculate weekends and holidays during the interest period and not the observation period. My colleague Lizzie will now take us through a couple more of the technical and mathematical conventions that are recommended.
Thanks, Barry. So Barry has obviously explained to us now the observation period method. Now, how do we find our observation period? So the recommended convention is to use a 5 business day lag. So for every day in the interest period, the rate 5 business days prior will be used. So where the following days in the interest period are not a business day, the prior business day's rate is weighted for the number of non-business days for which it will be used. This is intended to remove the effect of weekends and also gives you time to calculate the interest rate before it's applied to the interest period. And then if we move on, we'll look at some of the final conventions. rounding. The rounding convention for the daily risk-free rates is 5 decimal places for SOFR and 4 decimal places for SONIA. There's also a recommended day count convention. The choice of day count convention actually determines how your annualized rates are quoted. For SOFR, this is actual over 360. For SONIA, this is actual over 365. We appreciate a lot of these conventions sound extremely mathematical, not necessarily something that any of our lawyers watching can easily get to grips with. So in the next slide, we're just trying to give you a sort of run through of how this rate might work for our normal 3-month interest periods. So we can move on to the next slide. So here we're going to attempt to calculate 3-month SOFR for an interest payment date on the 30th of June. So prior to your interest payment date, the agent will need to look at the daily SOFR for each banking day in the observation period. So your observation period will be 90 days and it will end 5 business days before the interest payment date. So in some months that could be the 25th of June. This year that would have been, I think, the 23rd of June. The daily SOFR rate is used to calculate a non-cumulative compounded rate for each day in the interest period. However, as per the look back without observation shift method that Barry explained, for each calendar day that is a weekend or holiday, the immediately preceding banking day's rate is applied and weighted by the number of calendar days until the next banking day. So Friday's SOFR rate has a weighting of 3, as it will be used on Friday, Saturday and Sunday. The SOFR rates, the credit adjustment spread and the margin are multiplied by the loan balance, which generates the interest amount payable on each banking day in the period. So once the overall interest rate has been calculated, it's then communicated to the borrower ahead of the interest payment date. Obviously, this calculation is a sort of a lot more complicated in terms of a facility agent's role than just obtaining a screen rate. It's hoped that the market will start to offer solutions for reference rates, such as producing published compound rates, so 1 or 3 month compounded averages, or even publishing or allowing access to a compounded interest calculator that would allow participants to calculate compound interest over any period. Thank you for listening. That concludes today's Trinity Talks. I'll now hand you back to Rinku for our Q&A session.
Thanks very much, Elizabeth and Barry. We have had a few questions, so I'll run through them in order. First question we have is there recommended drafting to take account of, firstly, the need to change provisions of loan documents, and secondly, the actual method for calculating interest using a risk-free rate? Barry, if I could pass that question on to you.
Absolutely, Rinku. I'm happy to take that question. Thank you for it. Of course, this is the question that's the lifeblood of lawyers. We're very happy to answer it. There are, I think, 3 things that are asked in this question. One is there language for a process for determining how we will move from LIBOR to a new rate? And yes, there is recommended language out there. It describes a process. There are many options in it, such as how many of the loan participants need to take part in it. But it is there, and in fact, at this point, almost any document should either be drafted with that language in it, or that language should have been drafted into the document, possibly by way of a separate side letter amendment, and so we should all be familiar with it. But that language could go further. That language could provide a sort of a term sheet for the basis on which the new rate will be decided. And again, there are recommendations in the various institutions that make recommendations, like the Loan Market Association and the LSTA in America, that provide a sort of template term sheet. Now that we have recommended conventions, the ones we were just explaining, it's quite possible that people can begin to fill out that term sheet, so that at around now, or certainly between now and next June, borrowers and lenders have a very good idea of how they will move to a rate in future. And finally, there's a question of whether there is the actual kind of drafting that we will see from, at the very latest, next June, telling us exactly how we're going to calculate interest on loans. In the dollar markets, there is recommended language. The LSTA has this all worked out. It's been through the various reviews that such a process should involve both lenders and borrowers, and the LSTA has recommended language available on their website. The LMA in London, providing the basis for most of the documents that we deal with day to day in both the offshore dollar markets and other currencies, does not yet have recommended language for SONIA or indeed SOFR-based rates. That's sterling or dollar rates. However, they have produced what they call exposure drafts showing how they will work. And those drafts are available on their website, and people can certainly look and comment on them. I would imagine that very quickly now, those exposure drafts are going to be finalized on the basis of the recommended conventions. I know that the various working groups have been working and reviewing those drafts, and I would think that sometime quite soon we will have recommended LMA language too. Certainly, if you're going to enter into a transaction over, let's call it the next 6 months, you should be asking your lawyers to pick up that language and draft it into your documents so that they are ready to go by the middle of next year.
Thanks for that, Barry. And just in terms of the term sheet, are we still seeing that, you know, lenders or borrowers for that matter have leeway in sort of deviating from the LMA suggested language, so that, for example, lenders have more flexibility to choose the kind of replacement rate?
Yes, they certainly have flexibility. These are just recommendations, and it's all subject to commercial negotiation. But I would imagine for most borrowers and most lenders, they will now begin to pick up these recommended conventions, and most of the market will begin to generate rates on roughly the same basis. Obviously, there will be differences. Margins will certainly change. Credit adjustment spreads may be negotiable, but I would think your basic mathematical conventions and the basic rate, whether SOFR or SONIA, will probably begin to coalesce for most parties.
Thank you. And if I could just stay with you for the next question, given the imminent deadline, how many transactions have actually used the new risk-free rates in the market in your experience?
In my experience, 0, because I haven't had to do one yet, but I am aware, of course, of what is happening in the market. The derivative markets have been working on the basis of risk-free rates for quite a few years now, and many transactions in the derivative markets have been done on this basis. In fact, many of the conventions that have been picked up for the loan markets are based on those derivative market conventions. Similarly, the floating rate note market has had quite a number of transactions, again, using the conventions that are now entering the loan market. And which can be observed, and which are showing that these risk-free rates are actually generating very useful interest rates for financial products. But in the loan markets, there haven't actually been very many transactions. In the sterling markets, there is a public list of transactions. It probably doesn't include all of them, but pretty close, because banks have been pretty good about letting the market know when they've been entering into these newly based or new interest rate based transactions. And that list is about a dozen transactions long, some quite big, but not very many of them. In the US markets, things are not all that different. Relative to the size of the market, there have been very few transactions. I would think, however, again, because the conventions are now really quite settled, because people are getting used to the way the rates are working in other money markets, such as derivatives and floating rate notes, we will begin to see many more transactions. And certainly if the recommendation is that there are no new transactions in the sterling markets by March and in the dollar markets by next June, it's inevitable that we're going to see term sheets on the basis of new transactions and documentation for a new world imminently.
Thank you for that. The last question I think we'll have time for is one that perhaps I could ask Elizabeth to take. The question is that LIBOR is used in commercial agreements as well as loan agreements, clearly. And so how will the new risk-free rates be used in commercial agreements? If I could pass that over to Elizabeth, if I may.
Okay, Riku. So in terms of using LIBOR in commercial agreements, probably need to split between, some commercial agreements might be actually calculating interest on a regular basis as an interest payment. Now, if that interest is calculated with reference to your own costs of borrowing under a different finance agreement that refers to LIBOR, then really you need to be aligning that contract with your financing agreement. So if your financing agreement is moving towards one of the risk-free rates, you need to transpose that across into your commercial contract. On the other sort of spectrum of references to LIBOR in these contracts, some long-term contracts simply use LIBOR as a component of their default rate of interest. So it's not necessary that you immediately react and start trying to work out how to build software into your default interest rate, for example. But you might want to consider adding in some kind of clause to newly drafted contracts that acknowledges that will be replaced by sort of the market standard risk-free rate once the market has caught up and decided how that drafting works. So really for existing contracts, unless you're actually using a screen rate on a periodic basis to calculate interest, I wouldn't say any immediate action needs to be taken. But for any contracts you're drafting now, it's definitely worth future-proofing them and referring as in much detail as you wish to the type of rate that will be replaced once the market catches up and has the drafting available. Obviously, the one thing to avoid is a very tricky agreement to agree, which is not actually a binding contract, but it's definitely worth indicating that you and your counterparty acknowledge that there'll be a move to these risk-free rates and that in due course you'll sign a short amendment to introduce them to your contract. I hope that's clear.
Yes, thank you, Elizabeth. So I think that concludes our presentation and Q&A session for today. Just a reminder that we've got a number of upcoming talks this autumn. Please do sign up for these by emailing events@trinitylllp.com. And all that remains for me to say then is thank you very much to the presenters. Thank you everyone for joining today, and we look forward to seeing you next week. Bye-bye.